Welcome back to Credit Conversations. I'm your host, Traci Krepper, joined as always by Craig Lupton, and our special guest today, James Ison, Head of Economics at Experian UK. James, let's start with you. Can you give us an overview of how the UK economy is faring?
Yeah, so we've seen a few short periods of strong growth. First half of 2024 looked like the economy was turning a corner. Actually, in the latest bit of data for February, a strong increase. Though generally, since the pandemic, we had a strong rebound in 2021, but broadly, growth has been relatively weak. There are some brighter spots. Inflation has come down significantly, hit the 2% target in 2024. This year, it's ticked up a bit, but at 2.6% as of March, well down on where it was. And on top of that, pay has actually grown really strongly. So everything that's been thrown at the labour market, despite all of that, pay's growing at 6% year on year, roughly, which means that we're outstripping inflation, affordability is improving, people are becoming better off. On top of that, and we'll get onto some of the risks I'm sure later, but interest rates have come down from a peak of 5.25% to 4.5%. As such, mortgage rates are a little bit lower. So both in terms of incomes, supporting unsecured credit, on the secured side, a little bit of a boost in terms of lower mortgage rates as well.
That would lead us to believe that there's a lot of opportunity for credit growth. Craig, from your perspective, what are we seeing in terms of growth numbers from credit?
Yeah, so it's been a very strong start to 2025 in terms of unsecured credit, pretty much continuing the story we spoke about in these sessions before. We just talked about strong credit card numbers coming through. Q1 2025, we've already had 2.5 million credit cards being issued in the UK. Now that's up from 1.8 million in 2023, 2.1 million in 2024. So strong growth in the card market. Lots of supply from lenders, there's competitive products out there, meeting all ends of the market on there. So very much continuation of that story and that side of things. Personal loans, again, growth in unsecured market and personal loans. We're seeing strong volumes being done, again, across the spectrum in terms of appetite from lenders, but also consumers coming to market as well. The one big positive is the mortgage market. So we've seen, as James has mentioned there, we've talked about the changes in rates. We've got lenders coming into market now with competitive rates out there for borrowers. And March has actually seen the highest number of mortgages since September 2021 that have completed. And that's been a rush to get in, obviously ahead of the stamp duty changes, but somewhere in the region of 144,000 new mortgages completed in March, which is a really, really strong number. And that market's now moved into growth by 33% compared to this time last year on there. So some real positive numbers in terms of the consumer credit markets.
Craig, last time we spoke, we talked about a seasonal increase in delinquencies that we were seeing. How is that faring now that we're into the first quarter in 2025? Yeah,
so we have started to see some of those rates fall back down now. They're falling back in line with where we would expect them to see. So the longer run trends in terms of delinquency rates and consumers in difficulty with their payments on there is a sort of stable trend at the minute. There are some pockets of stress emerging, and we're starting to see some, you get below the headline numbers on there are some levels of vulnerability coming through. So some higher risk lending in the personal loans market, and particularly where sort of credit union style lending, and we're starting to see that emerge into sort of higher levels of arrears coming from that smaller group of customers in that side of things. And also in retail finance, we've had a deepening of risk. So lenders have gone deeper into that market in terms of the levels of higher risk lending they're doing. And again, that's starting to manifest itself now with some higher rates emerging from that cohort of customers. But ultimately, the story in delinquency, it remains identifiable and it remains predictable. So if you can use the data, you can see where those numbers are going to come from.
So in terms of those higher risk areas, what should lenders be doing? What do they need to be mindful of?
Again, key for them is to know their customers, understand those customers, use the best scores, the best data they have available to be assessed, whether it's onboarding new customers or whether it's customer management activities, or whether it's just helping out customers who are starting to struggle with their payments. Understanding that full customer position, recency of data behind those customers will help them mitigate any risk that may appear within their portfolio.
So James, we talked about opportunities in the economy. What do we see as potential risks or challenges that are emerging?
Yeah, so several clear risks and challenges out there. The government's fiscal position is challenging. We saw big increases in government expenditure announced in the autumn budget, but some of those have been rolled back. So there's been cuts to spending announced, given that borrowing is high. And as I've said, GDP growth has been relatively weak. So we could see further spending cuts coming down the line. In addition, those tax increases that were announced in the autumn budget, those very much remain. We've just seen the increase in employees' national insurance contribution, so an additional cost to businesses, and unfortunately we could see further tax rises coming down the line. So that's a clear one. On top of that, the global picture's become more challenging. There's been an introduction of tariffs, those potentially making UK exports less desirable. On inflation, it's relatively ambiguous. There are upward and downward impacts coming from a global sort of melee. Some of those, potentially, we could see goods that would have gone to the US now redirected to the UK and come through potentially at a lower price. There are actually upsides, or in terms of inflation, downside risk to that outlook. So I would say it's mixed on inflation, but there is certainly some challenges in terms of activity. Our baseline inflation assumption is that we're going to kind of tick up through this year, more so due to energy prices, the Ofgem energy price cap, water bills are set to go up, council taxes going up, phone tariffs. So there are a lot of pressures and upward contributions to inflation over the coming year.
James, thank you for that overview. Craig, how does that equate to opportunities or challenges that we expect to see in the credit market?
Yeah, I mean, also we've been talking about strong growth currently on there, but I think it's fair to say consumer confidence is quite fragile at present on there. So a lot of these headwinds that are in the wider economy are likely to start to dampen perhaps some of those consumer appetites for unsecured lending. So we think that we're still going to see growth this year, but I think it's going to start to slow down as we move through maybe into the second half of this year. The mortgage market we are a little bit more confident behind. There's obviously more positive news around the base rates and the consumer confidence in terms of taking out new house purchases. We think that will flow through nicely, and therefore that market should stay a little bit more resilient as we move through the end of the year. Obviously all the household costs that James has been talking about there and the pressures on those households, it's going to make even more challenging for consumers in terms of managing their day-to-day finances, their affordability pressures. So if you're looking to borrow to these customers, you need to understand the full picture behind their finances. What pressures have they got today? What pressures are they likely to face in the coming months as these costs obviously flow through into those household finances as well.
Craig, to sum up, it sounds like there's stress on the horizon from an economic perspective. We see that, but there's obviously opportunities for growth. Credit lending is still up. Help us understand where those pockets are.
Yeah, I think, again, we've got a turbulent time, as James talked about, in terms of the economic picture, but there is opportunity for growth out there. Wage growth is strong. There are people that are going to ride this way through, so those are the people, if you can target those, you can use the data to identify those customers, you can grow to those particular customers. Risk, as we spoke about, remains predictable, remains identifiable. So again, using the data, using the recency of that data to be able to predict who you want to lend to, who you want to target, who you want to manage, gives you those opportunities for growth and that confidence in being able to do it in the right way.
Thank you again for joining us today, and thank you all for listening to another edition of Credit Conversations. We'll be back again next quarter for our next update.